Frederic, great to have you back. Good morning.
Very good morning to you, too.
There is a view this morning that the committee or Powell himself is going to sort of take into consideration the weaker Fed regional surveys, PMIs barely in expansion, cooling wage expectations, and that's causing the market to price in, as of this morning, fewer than 4 hikes this year. How valid do you think that argument is?
Well, I think actually the Fed is behind the curve. So that despite a little bit of weakness and the fact that we're more worried about Omicron, when you're behind the curve, you got to do your job. In fact, the Fed actually has changed its story quite a bit recently, actually talking about raising rates much faster and earlier than they originally had. That's good news. But I think there's absolutely no reason for them to move in the other direction. If anything, they're still a little bit behind the curve. We've had inflation much higher than we expected. I had a Financial Times piece recently that pointed out that there's flaws in their basic framework that they're using, and as a result they've been too expansionary. So they need to tighten, and they need to get to it.
Do you think 50 basis points at any point is warranted?
No, I don't think they need to do that. I think that moving gradually, I think, makes sense. And similarly, moving gradually on shrinking the balance sheet also makes sense. There's no panic here that we need the Fed needs to do. They need to basically to move a little bit faster and to communicate that. It's that simple.
Well, you mentioned the balance sheet, $9 trillion, Frederic. I mean, how quickly should they move to reduce that number, which is almost an unimaginable sum of money?
Well, I think that in the previous episode where they increased the balance sheet tremendously during the global financial crisis, they were much more gradual than they should be now in terms of reducing the balance sheet. In fact, in this case, their gradualism worked quite well. In fact, at one point, they reduced it a little bit too much and had to back up a little bit because of their new operating procedure as a result of the changes that they made. Now it's clear that they have to get back down to something much more normal. In fact, also because you want to have that ammunition ready in case you need to do expansionary policy again when interest rates fall to zero. So I think that they should be much more aggressive in actually not starting with reinvesting, but actually have a plan for shrinkage, not to roll over the debt. And that's, I think, what they need to start doing. They need to start doing it very soon. And I think we'll start to hear more about that, both in terms of the minutes, the announcement, and so forth. That's what they've got to plan on, and it's got to be, getting gradual, explained up front, so there are no surprises. It's a technical correction, but they need to move in a very different way. The economy's in a very different situation now than when they started to unwind after the global financial crisis, where the economy still was weak and inflation was too low. Now the economy is maybe a little bit too strong, but we don't know. We'll have to see with Omicron. But certainly inflation is way too high. Very different environment.
Shepard Smith here. Thanks for watching CNBC on YouTube.